There's a dislocation in some global markets, especially when looking at indices, and the US markets, especially Wall Street, seeing record highs for many of the benchmarks. Bryan Noble joins us now from TraderNoble.com. What do you put behind this big dislocation between, let's say, for example, what's happening here in the European markets, where we're struggling at levels well below record highs, but we're touching or very close to being at new record highs in the US?
Well, the growth in the US is, second to none compared to Europe. The policy is different in the States. Obviously, Trump has come in, he's cut the capital gains. He's to 21%. He's trying to get growth and business growing. He has. Unemployment is down to record lows, and then against that we've had a huge sell-off in the emerging markets. But I think it's interesting. The last sort of 6 or 7 days will be really interesting for the markets. The emerging markets are beginning to find a bottom. For the case, the Hang Seng, which have fell 20% from January, we've now broken up above the 26,000 level. As long as that level can hold, and then if we go closer to Europe, then if we look at the DAX, there's an inverted head and shoulders in the DAX that it's bounced off the 11,750 to 850, which it had to do. If it broke below there and closed below for a couple of days, then the next downside target was 10,000. So we've finally seen some sort of support in the European and the emerging markets.
Okay, well let's apply some charts to these, because I think it's worth looking at in terms of some of the price action that we've seen. Let's bring out the S&P 500 first of all, where I think at the moment the spread on the clients is at the moment is 62% short on this. And as I said, we are at these record highs. Where do you see this market going? I mean, we are at these highs. Which market is going to give? When you get this disparity between the markets performing well and the markets very weak, is the US market going to pull back to join the weakness in European and emerging markets, or are they the ones going to be catching up and moving higher to join the S&P 500?
I think this week has been crucial what's happened, as I mentioned there, with the DAX and the Hang Seng. As regards the S&P, I've been a big buyer all year against the 50-day moving average. As long as we hold the 50-day moving average, this market is going up. And people have been, I've seen, we had a sell-off last Friday, and suddenly you've got these analysts coming out saying that's the top, we're not going to see any higher market, we're looking for a crash. How can you call a crash when a market has moved 30 points from record highs? It just doesn't make sense. I know the breadth is awful. My own view, despite the fact that we're in the weakest 4-week period of the year, as long as the S&P can hold this 2850 support, which is the 50-day moving average, and then below that then we've good support for the 100-day, 2795, and 2750 for the 200. So there's a lot of support within 150 points of where we're trading at the moment. And I've been consistent all year, just buy against this 50-day moving average, buy the dip. We saw the other night, even when Trump came out with the tariffs, S&P got down to 2879, everyone got bearish again into the hole, and then we rallied 30 points yesterday, and another upward reversal. So sorry,
I was going to say, let's have a look at this then against the Hang Seng, because you mentioned that 20% plus decline that we've had, technically a bear market, and we see some support actually, interestingly, around previous resistance level at 26,000, and it bounced off that neatly. Are you persuaded by that? Do you think there's now time to go long?
Yeah, as long as I buy it against 26,000, it probably, the problem when you're trading the Hang Seng, because it's such a big contract, right, you got to have wider stops. So you kind of have to have an 800 or 900 point stop if you're getting involved in the Hang Seng. So as long as 25,800 holds in the Hang Seng, we should go back up and test to 24,100, which is the next support, or sorry, next resistance, and then push up from that. But obviously it's still a bear market because we're below the 200, 150-day moving averages. But with a 20% fall, which is a classic, bear market, everyone gets bearish into the hole, as I say, and then the market turns around. And it was interesting. Templeton came out the other day, who a lot of investment in the emerging markets, and they said they think the market is close to a bottom. And interesting, close to Hang Seng, we've seen the Nikkei break out when it broke above 23,000 last week, and we're suddenly 23,700. Obviously, the weaker yen is helping. We had the Bank of Japan monetary policy remained unchanged today. Nothing new in the press conference, and people bought the Nikkei again. So
yeah, let's take a look at the Nikkei chart. We're not too close not too far away, I should say, from this point of resistance. We had the peak high 23rd of January 2018 at 24,192. At this big rise that we've seen, do you see that as an easy target to reach?
Well, it's interesting. The Nikkei is in touching distance of that 24,000 resistance level, and yet the Hang Seng was 20% below last week in the market. So it was certainly the Nikkei is playing a bit of catch up with the States. And in contrast, then if you go back to Europe, as I said about the DAX, if you want to put that up there, just we've an inverted head and shoulders on the DAX, and if we break where we bottomed there at 11,850 last week, if we can hold that 750, 850 support, which is crucial, then the DAX should go back up and test their downward sloping moving averages, as we can see from there. Obviously, it's going to take a lot to get a bit above that, but I think the Bundesbank coming out with the report saying that the growth is understated, and they expect to see a lot firmer growth in Europe, particularly in Germany, should add support. But then against that, then we're seeing bond yields at near record lows. I know we've had a bit of a sell-off over the last 10 days, but still, 45 basis points for 10-year money is insane 9 years into an economic recovery.
Yeah, let's just bring up what's happening on the foreign exchange markets. I want to go first of all with the dollar basket. We've seen this head and shoulders peak here. Do you see the downside is the major play here on dollar basket? Weakness for the dollar, and I mean that would play neatly into this idea that perhaps maybe the emerging markets are bottoming out.
Yes, and I think for the dollar to gain more traction on the downside, it needs to see this 93.50 support area broken for the dollar. The dollar's probably oversold at the moment. It probably will bounce off this 93.50 support, but I will be a buyer against that 93.50 support initially, looking for a bounce, but I think ultimately we will break down. The euro has got key resistance at 117.20. We've tested on 5 or 6 occasions already. Each time it's come back, but the sell-offs are not as aggressive as what we had before. So I think if we can take out this moving average at 117.20, then we should have a run up to the 200-day of 119.80 119.50 over the coming weeks.
Yeah, okay. One last chart I do want to talk about, and today we've had some interesting data coming through about sterling because we've seen stronger than expected inflation numbers, and then of course there's this weakness coming through as a direct result of what might be perceived as a little bit of a bump in the road in terms of negotiations for Brexit. We've got a fair bit of money going into sterling at the moment against the US dollar. Do you see that trade continuing on the uptrend?
Yeah, I mean, I certainly wouldn't be short sterling. Sterling's had an aggressive sell-off since the beginning of the year. I think this 129.50, 130 is very good support, so I think as long as we can hold above that, then we should start to break. Obviously this morning's high 132.15 is crucial. If we can get back above that, then we should. There's no reason why we can't have a run back up to 135.
Yeah, clients 63% long, so they're right side of the trade on this one.
Yes, and it's funny, when the S&P was 62% short when I was here 2 months ago, we were 90% short, and the S&P is up 100 points since then. So these sentiment readings that IG produce are fascinating. They have a great signal. They've worked brilliantly in gold and silver if you're a contrarian trader, because they've been long. Gold, I think it was 93% the last time we were here, and gold's down $100 since I was here. So they certainly well worth keeping an eye on.
We'll talk about gold on another day, but Bryan, thanks indeed for joining us with a look up there at the markets and what's happening in terms of some of the breadth or lack of it in terms of the spread around the world for those indices. That was Bryan Noble from TraderNoble.com.